Good afternoon, everyone. Welcome to NOVA 401k Associates webinar on Introduction for Plan Sponsors. Today's webinar is eligible for Texas CPA and ASPA CE credit. Right after the webinar ends, you will see the survey pop up if you are needing either of these credits. We have also added the slides as a handout. Just click the handout dropdown on your GoToWebinar panel and you can download and save to your local folder. Today's presentation will be presented by Senior Account Manager Charlene DeMartini. If you have any questions, please type them in the questions box and we will go over them at the end of the presentation. Charlene, please take it away.
Thanks so much, Jasmine. Hi, everyone. Thanks for joining us this afternoon. We have a lot of information to cover in this presentation. So as Jasmine said, just let us know if you have any questions. We'll get them to them at the end. And if for any reason we don't have time, then we'll email you with the answers as well. This webcast is Introduction to 401k Plan for Plan Sponsors. And if I could get my slides to work here. Hold on. Here we go. Just a quick disclaimer that this information is general in nature and not intended to be a substitute for legal or tax advice, and to please consult a qualified professional such as an attorney or an accountant if you need legal or tax advice. We do offer CPA credit. Our provider number is 009820. You must register individually and be present for the entire seminar, which is an hour and a half today. Complete the evaluation form, and then you'll receive a certification within 1 week. Again, we have a lot of information to cover, so our agenda is going to be first talking about the roles and responsibilities and what the duties are for everyone involved in your plan. We'll go over NOVA cybersecurity measures, 401k basics, moving pieces, distribution basics, loan basics, and then we'll go over an annual calendar for what you can expect throughout the year. So our first slide here is going to be pretty handy to you guys that have not dealt with a 401k plan before, and it shows all of the individual companies that are included in your plan administration. The first is going to be you as the plan sponsor on the top left there. And as the plan administrator, you have overall fiduciary responsibility, communicating the plan to your participants, remitting the plan contributions, and then providing the data to NOVA annually so that we can complete our compliance portion. And we'll go over that in detail. On the right side, you'll see the financial advisor. This is going to be the broker on the plan. They're going to assist you with the vendor selection and monitoring of the funds, coordinate the enrollment meetings, and provide investment education to your participants, as well as assist you with the 404C compliance, which is to make sure that your fees are in line for what they should be for a plan of your size. The bottom left, you'll see the investment provider. This is the actual custodian of the plan assets. So this is where your assets are with the plan, where you remit contributions. Those plan contributions will be invested and provided as a daily record keeping. So the money will be invested into funds and hopefully earn money, not lose money in those funds, but that can be seen daily by the participants. They'll provide the participant statements, and that's done on a quarterly basis and are typically mailed to the participant's home. And they'll also provide the distribution, withholding, and reporting for any withdrawals that are taken from the plan. And then us, NOVA, on the right bottom is the TPA for the plan, the third-party administrator. We do several things for your plan, including prepare and maintain the plan document. The plan document houses the provisions for the plan, and it's the legal document. We complete the annual testing each year, and that's what we will need the data that we talked about up here on the left-hand side, and we'll go over that a little bit later. We prepare the annual filing. So if you've heard the term Form 5500, that's the annual filing that is due each year for each retirement plan, and we'll prepare that each year as well. And then in addition, provide any ongoing plan consulting. There's a lot of consulting that could go on with the plan depending on how much activity you have. So if you have questions on rehires, if you acquire a firm or you're being acquired, any of those types of things that can come up throughout the year, those we would also help you with as well. So the first thing we want to talk about is NOVA cybersecurity measures. And this is really important to us because there's a tremendous amount of money in 401k plans. And as we've quoted here, the bad guys have taken notice. So unfortunately, there's a bunch of fraudsters out there who know where the money is, and they will do whatever they can to take it, apparently. But we have put security measures in place here at NOVA because we know it's important to protect that information that we get, because we do get Social Security numbers, dates of birth, dates of hire, and then of course we do have a role in helping that keep that money safe at the record keeper as well. But there's several ways that these bad guys have trying to get money out of retirement plans. Could start from a phishing attack or hacking an employee's email. Attackers then contact the record keepers and reset the passwords. And then with those new passwords, they can request loans and distributions. So on our side, we have a loan and distribution department that will complete fraud checks to make sure that those distributions and loans are valid. With ACH and wires, typically on trivial amounts are recovered, but not typically the higher amounts are recovered when the theft is discovered. And that's because this type of theft is not covered by Fidelity Bond, fiduciary insurance, errors and omission insurance, unfortunately. So we all have to be alert and do the best we can to prevent these fraudsters from succeeding and taking any money out of the plan. Again, I mentioned that we have census files, deferral files, payroll files, address files, as well as you guys do as well. So for this reason, we would not send you anything with this information without encryption. And we have our own web portal that we typically will use to house those documents so that it requires a login to get that information. And that will also include any of the non-discrimination testing files that we provide to you. We do mask the Social Security numbers, but some vendors do not. Annual valuation reports to show the values of each participant's account. And then, of course, you guys may have W-2 forms or K-1s or even Schedule Cs that you're providing to us as well. So again, a lot of information that we want to keep confidential. If you haven't been to our web portal yet, our web portal, I think it's a pretty cool web portal. It's very user-friendly. But again, this is our secure web portal where we can transfer files securely, and that would have to be logged into to be able to pull those files. So if you have anything that you're sending to NOVA, please use that secure file transfer, and either myself, you could call myself and ask how to do that, or of course your account manager can help you with that secure file transfer. We do have encryption software that we can use time to time, but we prefer using the secure file transfer. Any new contacts on the plan, we will request an email so that it's in writing that we're adding someone to your plan so that they have access to the information on our web portal. Typically, this is not done by a phone call or someone that we don't know giving us permission to do so. As a NOVA employee, we have mandatory training that's required every quarter, and we have to sign off that we've completed that training. So again, we take it very seriously, in addition to having our policy, password policy, which has to be changed every 90 days. Any passwords that we have for any record keeper or vendor, we change every 90 days. We're going to go into the annual calendar, and I'll let you know about the census upload, but each year, in order to complete our compliance testing, there is a census that we need, and that census has a lot of this information on it that includes socials, date of birth, date of hire, compensation, all those types of things. And that would be uploaded to our plan sponsor link as well when you're filling out the questionnaire each year for annual compliance. So again, this census data should be uploaded through our portal, not through email. Limiting the number of people copied on emails, and of course use complex passwords and change them often, is what we would encourage you to do as well. So again, just wanted to cover the cybersecurity measures because you will see that we have a lot of secure information. And if you have any questions, just let us know about that. And with that, we'll start getting into the actual 401k basics. 401k plans give employees an opportunity to save for retirement on a tax-preferred basis. It's an easy way for participants to save because it comes directly through payroll deduction. They fill out an enrollment form of how much they would like to defer, and by magic, it goes through their payroll and goes right into their account as a record keeper. So for this reason, because it is so simplistic for a participant, it's their biggest asset outside of their home. So, we want to encourage retirement funds for people to have that for when they retire. And of course, it's a valuable employee benefit. I'm not sure that anybody would go to a job these days and not expect to see that they have a 401k plan, whether or not the employer puts funds into it or not, but at least for the employee to be able to save on their behalf. But with that, even though we make it more simplistic for the participant to enter the plan, the 401k plans are heavily regulated by the Internal Revenue Service and the Department of Labor. So we do keep up on all of the laws that change frequently. And of course, with all of the pandemic, the last year and a half or so, even more regulations have come out for retirement plans. So we will let you know when those regulations change and let you know how they affect your plan as well. But in saying that, with the regulations, common sense doesn't always help. We're going to go through some circumstances where you might think that a retirement plan would be set up one way, but in actuality, it's a separate way. But we just want to make sure that the plan is set up to what you intend it to be. And so if there's anything in your plan that comes up and is not operating the way you think it should or the way you want it to, just contact your account manager so we can make sure that the plan aligns with those intentions. Again, the rules change frequently, but in almost all cases, your written plan document controls. And this is why I say if it's not operating the way you intend, to let your account manager know so we can make sure those legal plan documents line up to what you're intending. When we talk about the Internal Revenue Service for the plan, they are mainly concerning themselves with compliance for the federal statutes and IRS regulations, which deal with the taxable events, deduction limits. Uncle Sam wants to make sure they're getting their part. The non-discrimination testing that is completed each year, and again, we'll go over some of that testing. That the plan documents are amended timely. NOVA will let you know if we don't have a signed document so that we can keep those on file here, but the original plan documents would be kept in your files. And of course, we want to make sure that the terms of the plan document are followed because the IRS, if they're auditing your plan, are going to make sure of that as well. And then next, we have the Department of Labor. The Department of Labor, as you might determine, is based on or concerns itself more with the participants. And so they want to make sure first and foremost that the 401k contributions and loan repayments are deposited timely. And we're going to go through what the deposited timely means to you. That the lineup offered to the participants is prudent. This is where your financial advisor can help you to make sure that you have a range of funds that are available from conservative to less conservative or aggressive. The expenses that are paid by the plan are reasonable. And again, the financial advisor can help you with that as well. and then that the Form 5500 is submitted to the Department of Labor on a timely schedule. So again, two different bodies of the government, but making sure that there are different things completed with the retirement plan, and we want to make sure we stay within those regulations and keep the plan in compliance, and that's what we're here for. So we'll go through a couple of examples here of what maybe you thought would be common sense for your other benefits, and maybe what is actually in the regulations for retirement plans. And the first example we have here is that maybe you want to exclude hourly employees from your retirement plan. You can do that. There is some additional coverage testing that's required, and we'll go over what coverage testing is later in the webcast. But we also want to make sure that the plan document is written to exclude those hourly employees. And this is just an example for hourly employees. You might have, maybe you want to exclude highly compensated employees from the plan. Maybe you want to exclude salespeople from the plan. There's a multitude of different definitions that you can exclude from the plan, but we want to make sure that it's a definitely determinable group, as well as making sure that it will pass coverage testing each year. Another example here of common sense versus the regulations is making sure the preferred investment alternative for an employee. If an employee fails to make their investment election, where is that money contributed to? What fund does it go into? And until a few years back, that might have been the money market or stable value fund, because common sense would say, well, that fund is going to be dollar for dollar of what the employee invests. Well, in certain markets, you could have the expenses that make that money market or stable value actually come into a negative earning. So the Department of Labor changed the regulations to say that they thought a more prudent investment would be a balanced fund or life cycle fund, which would be based on the participant's retirement age. So it would be less aggressive or more aggressive depending on the age of the participant. So again, just something that maybe common sense wise, you would think it would be money market or stable value, but it's changed recently. Next, we'll go over the timely deposits of the 401k contributions. And this is going to depend on whether or not you have a small plan or a large plan. And when we talk about small plans and large plans, the determination of that is dependent on how many participants you have that are eligible for the plan, and that would include any prior terminees that have account balances. So if when you add those two groupings together, then, I'm sorry, I'm getting pop-ups, and I thought that I had gotten rid of pop-ups. Sorry about that. In any case, if you have over 100 participants, when you add those numbers together, over 100 participants would make you a large plan filer. And so when you complete the 5,500, you would also be required to have an independent audit. So when we make that determination of a small plan versus a large plan, the deposits of the contributions are different to make them timely. For a small plan, so less than 100 employees, the deposits are due no later than the 7th business day after the amounts are withheld. And so if you have a pay period that ends this Friday, then your withholdings for those 401k contributions and loan repayments must be deposited to the record keeper no later than 7 business days after Friday. On the other hand, if you have a large plan where you have more than 100 participants, there's a specific definition to say as soon as administratively possible, or the earlier of that or the 15th business day of the month following. And I don't see this so much anymore when we take over a plan, but there's been plenty of plans that we've taken over that the employer was always under the understanding that it was the 15th business day of the month following. not realizing that there's another part of that definition saying it's as soon as administratively possible. And so you want to make sure that you are never using that 15th business day of the month following. Typically, the IRS is going to find that if they're going to follow when you can deposit your federal taxes, and that, of course, is no way that's 15th business day of the month following. So you'll want to make sure that you make that as soon as administratively possible. And typically, they'll think of that as being less than 7 business days as a small plan. For a large plan, it's usually going to be 3 to 5 business days. This is a huge issue in Department of Labor audits, as well as subject to the CPA audit. That's going to be one of the first questions that either audit is going to ask is, when did you deposit the contributions? And they'll ask for a schedule of each pay period and when it was deposited. And typically they'll want some kind of confirmation of those deposits. So again, you want to make sure that if you're not following these timeliness restrictions, make sure that you get on track with those. And if you did have some that are late, it is fixable. Everything in a plan is fixable, I guess, unless it's very egregious. But in this case, if the deposits have been late, you would calculate some late earnings that are due to the participants for the time period of when it should have been deposited versus when it did get deposited. So just let your account manager know that you might have a situation. We can gather some information and help with those calculations, and then just deposit those to the record keeper so that you can say that it's been completed if an audit ever comes up. Also, as we talked about, the Department of Labor is going to concern themselves with making sure that the 5500 is submitted to them each year on time. This is an annual report for each retirement plan, and it's an electronic filing. So NOVA will complete this each year for you and then provide a draft for your review. And if you agree, then you can go on to the website and electronically file that 5500. The information that reported on the 5500 is plan specific, not participant specific, but it does include the participant counts. So who's eligible for the plan, how many people have money in the plan, certain fees that are paid from the plan, an income statement. So it will show what the contributions are, the distributions, if there's any loans in the plan, and then of course include a financial statement of those assets. Sorry about that. On the 5500, the Fidelity Bond is reported each year. So you want to make sure that you have a Fidelity Bond on file. This is required of each retirement plan. And the Fidelity Bond is in the amount of at least 10% of the plan asset, but no more than a $500,000 bond. So if you don't have these Fidelity Bonds in place now, please make sure that you get with your provider of your corporate insurance, or we can provide a reference for a company to help you with that Fidelity Bond. But we'll want to make sure that we have that in place so that we can have the Fidelity Bond amount to report on the bond. And I'm so sorry, I'm losing my voice already. Get some water and see if that helps. Again, we talked about earlier that plans with more than 100 participants are going to require an independent audit. And when the auditor completes that audit, they'll provide a report of their findings. It'll include the schedule of assets and information about the plan. And that would be included with the 5500 filing that you file electronically. There are transition rules. So if you have less than 100 participants, there's a transition of how many participants you would need to have in that first year to move over to a large plan. So for plans that kind of move between 90 and 100 participants, that first year you would have to be over 120. So there is a time frame in which you can prepare to be an audited plan. And we'll look at that each year to let you know if you're going to be going over that audit threshold. Payroll integration, we wanted to go over this because the information that's provided to NOVA, of course, is all census related. And the payroll provider would submit a full census data each pay period to the record keeper in this circumstance for payroll integration, so that the information can go over seamlessly to the record keeper instead of you having to manually update it. So I would check if you want the service that we're going to be talking about. There's typically a setup fee with the payroll company that you have, but then it could be automated to send that information over to the record keeper for you. If you've already submitted a file, then you know this information I'm talking about, but typically you would only be sending a file with those participants that are making contributions. If you elected into payroll integration with your payroll company, this file could also include all the addresses, dates of birth, dates of hire, dates of term, all of that information that could be automated rather than you updating every time that something like this occurs. It could go over to them each pay period, so that this would include all employees regardless if they defer. Again, why would you want to use payroll integration? Because the annual census data can be pulled from the record keeper to make it more easy for you guys. Automatic distributions to participants. Once a termination date is received in the census file, that record keeper can automatically send a distribution packet to the participants. And if you're not aware, typically if your account is under $5,000 in your retirement plan, a participant can be forced out if there's no response within 30 to 45 days. And this just makes sure that it keeps your plan clean, that you don't have to be tracking down these participants for years to come that have less than $5,000. So it can help with that. Also, it can, the vendor can track auto enrollment, or rather enrollment. So if you have, to say, a 30-day waiting period and the vendor has already gotten that date of hire for the participant, just say they were hired today, they can notify that participant when that 30 days is up to let them know that they're eligible for the plan and can start participating. So again, that's something that they can take off of your plate instead of you having to complete. And then of course, the census data updated at the vendor, as we talked about. All the address changes, the dates of rehire, all those items can be automatically updated rather than you manually entering them. And there's two types of payroll integration. One can go one way and one goes both ways, the information. And this just really depends on the record keeper that you have and the payroll company you have. But the most automated would be Payroll 360. Again, that means census data flows both ways. The census data is provided to the record keeper, as we just talked about, from the payroll vendor. But in addition, any payroll changes that are provided to the vendor from the record keeper, that can be provided, like I said, to the payroll vendor rather. So if a participant goes into, just say, a record keeper, John Hancock, they enter that they want to change their deferral election from 3% to 5%. That payroll change can go directly to the payroll company rather than coming from the HR department, and make it a more automated process. Some payroll vendors are not able to complete the Payroll 360 with your record keeper, but they might have Payroll 180, which means that the census data provided to the record keeper from the payroll vendor, but the second portion of that, where the payroll changes that are reported to, just say, John Hancock, would not go back to the payroll vendor. So again, it could be both ways or just the one way, depending on which vendors you have. But if you don't have this now, I would highly recommend that you look into this just to make things more automated and take some things off of your plate, because I think all of us would like to have some things taken off of our plates. So looking at this payroll integration, again, we talked about this because Nova is going to get an annual census file from you guys each year. And that census file is going to include anything that happened during that year. So in January of 2022, we'll be requesting the census data from January 2021 through December 2021. And that'll include the date of birth, date of hire, compensation, the contributions, and all of that data is used by us to complete the non-discrimination testing. The first test here that we'll talk about is the most common, and that's the average deferral percentage testing. And that is just the acronym ADP that you'll hear. And that is where we compare the amount of deferrals from two groups. The first group is the highly compensated employees, and that's a defined term, and we'll go over what that means. And we compare that average of the group to the non-highly compensated employees. If the average for those groups are not within 2 percentage points, then unfortunately it does not pass. But as I said, there's a fix for everything. And in this case, the failures are corrected by issuing refunds to the highly compensated employees. So if, for instance, we have an average for the non-highly compensated group that's at 2% of pay, and the highly compensated is, we'll go with 5% of pay. So the disparity between the two is more than 2 percentage points. So we would bring down the contributions by the highly compensated down from 5% to 4%, so that we're within that 2% range. And the record keeper would refund that difference to those highly compensated employees. So again, it's fixable. There would be refunds involved, but again, it's a fix for that failure. Who is a highly compensated employee? This is a defined term, as I said. So this is defined in the regulations as any employee in the testing year who earned more than $130,000 in the prior year. So if you're a new plan to Nova, you may wonder why we ask for who made over $130,000 in the prior year. This is the reason we're asking for this definition. This definition would also include anyone who is greater than a 5% owner and any lineal family member or spouse of a direct 5% owner working at the company. So when you complete your annual questionnaire, you'll be asked on one of the tabs who the owners are. Again, this is why we need that information. And we'll have a tab for the family members of the 5% or more owners. So again, if there's any family members or spouses working at the company, they would be considered a highly compensated employee as well for this testing purpose. The next test that we prepare each year is the Topheavy testing. It's similar to the ADP testing in that we're going to separate the plan into two groups, but this one's going to be slightly different, and this is going to be the key employees. And again, we'll go over what a key employee is. And we're going to be looking at the account balances. And we're going to compare what the non-rollover account balances are for the key employees versus a non-key employee. And if those assets of the key employees are more than 60% of the total balances, then the plan is called Topheavy. And what this means is that a contribution, a Topheavy contribution, would be due to the non-keys for any year that the plan is Topheavy in which a key employee made a contribution. So if you have a plan that's not Topheavy, then that contribution would not be required by the plan. For who is a key employee, it's very similar to the highly compensated definition in that we're still going to use who is greater than a 5% owner and who is a family member of those 5% owners. But we're going to add in two more definitions. One is going to be a 1% owner with compensation greater than $150,000. And we're also going to add in an officer with compensation greater than $185,000. So you'll see on the questionnaire that we send you, we will also ask who the corporate officers are. And again, this is why we would need this information. Now, we do have what's called safe harbor provisions that are available. And if you have one of these safe harbor plans, you would be exempt from the deferral testing and the Topheavy test. So you would be deemed to pass those by making a certain contribution. And we're going to go over what those contributions look like. There's several definitions, but we'll go over the most common here. And the most common safe harbor plan definition is a matching contribution. And the most common is the basic matching formula, which is a two-tiered formula. So it's 100% match on the first 3% of pay deferred by employees. In addition, it would be a 50% match of the next 2% contributed. So in this formula, you'll see that the two tiers would take it up to a total of 5% of pay, 100% on the first 3, 50% on the next 2, so that if an employee deferred 5% or more, they would receive a 4% match. So that's the first most common formula. The second would be a non-elective. And the difference being here that a match would be if a participant made their own deferral. Non-elective would be also called non-matching, which would mean that it would go to participants regardless if they contributed their own funds or not. And that would be a contribution of 3% of pay. So a little bit different in the actual contribution that would go to a participant, 3% versus a max of 4%. But there are reasons that you would use the safe harbor match formula versus a non-elective. So you would want to get with your account manager if you're looking to put something like this in your plan to see how it could fit with your intentions of your plan. So the other regulation for a safe harbor plan is that you make a contribution, but also that that contribution is 100% vested immediately. So unlike a discretionary match or profit sharing where you could have a vesting schedule for up to 6 years, these contributions would be 100% vested immediately. So those are a couple of the non-discrimination tests that we complete for each plan, but there could be other testings. We talked about the coverage testing. The coverage testing is if you're excluding employees from a contribution. And that could be, as we talked about earlier, maybe you want to exclude hourly employees from the plan, or it could be maybe you are contributing a match or a profit sharing contribution in which you don't want terminated employees to get that contribution. Then we would need to complete the coverage testing. And the coverage testing is making sure that at least 70% of the eligible population receives the ability to have that contribution. So 70% of the eligible population means that anyone who is eligible for the plan. So if you've met your eligibility requirements, maybe you have 6-month eligibility, age 21, and you enter the plan monthly, anyone who has met that eligibility requirement would be included in the coverage testing. And then we would carve out those employees that you are excluding from that contribution. The next testing that we could complete each year is the profit sharing testing. There's many ways in which a profit sharing can be calculated. Again, it just depends on your intent of what your requirements are that year. So at the end of the year, when we get your census data, you can let us know that you're interested in a profit sharing, and give us some ideas of how you would want that allocated, and we can complete the necessary testing and let you know if that intended allocation is available. And if it is, we'll provide you with an allocation sheet by participant so that you'll know how much to deposit for each participant. The next testing that could be required is compensation testing. So just like we talked about earlier, where you can exclude hourly employees, you could also exclude certain types of compensation. The most popular to exclude is bonuses and/or commissions. And again, you can exclude certain types of compensation, but there would be a testing requirement, and we would need to test how much of the compensation that you excluded for the highly compensated group versus how much you excluded for the non-highly compensated group. And that, again, that would need to be completed each year if you're excluding compensation from the plan. We talked about earlier that the IRS wants to make sure that your plan documents are amended timely. Again, there's a lot of regulations in a retirement plan, and the plan document would outline what provisions you have in your plan, and they're amended time to time to keep current with the new legislation, as well as the IRS regulations. And again, we will let you know when that's required. The amendments need to be executed timely, and there can be penalties if you fail to execute timely amendments. So for this reason, you will be getting some notifications from NOVA if we haven't received your signed plan document. And again, we would keep a copy of those in our files. There's lots of things that are in the plan document. I would encourage you to look at your plan document again, like I said earlier, to make sure that your document is written the way that you intended the plan or operating the plan, that you know the eligibility rules, the entry dates of when a participant can enter once they meet those eligibility requirements. The compensation definition, as I said, you can exclude certain compensations. The employer contributions that are in the plan, whether that's a safe harbor formula, a discretionary match, discretionary profit sharing, all of those types of contributions in the plan. And then, of course, the vesting. There's many more items that are in the plan document, but these are just highlighting the top 5. Next, we're going to go over some common plan sponsor payroll errors of things that we've seen when we've taken over a plan. Hang on one second, I'll grab some water again. Okay, so a couple of things that we've seen, and again, these are things to look for in your plan as well, to see if the plan is written the way that you intended. The first is excluding bonuses from deferral elections. There are provisions in the plan that does allow you to exclude irregular pay or bonuses from deferral elections, but it must be written into the plan document. So the plan document will say the standing deferral election will apply to all pay, including irregular pay, or it could say that irregular pay does not have any deferral elections, or it could say that the participant can decide if they want to include any deferrals from their bonus or irregular pay. Any way you slice it, we need to make sure that it's in the plan document. Excluding part-time employees from the plan. You can do that. You can exclude part-time employees from the plan within a certain definition that's allowable in the document, but they aren't automatically excluded. So if you have part-time employees that you're currently excluding from the plan, just administratively in your day-to-day because they are not included for your health benefits, make sure that your plan document allows for those exclusions. Next is matching catch-ups separately from non-catch-up contributions. If you don't know the definition of a catch-up contribution, it's an additional deferral, salary deferral contribution that can be made for participants who are 50 years or older. And this just allows an additional deferral in the limitations so that those participants can save more as they're gearing for retirement. And that limit changes each year, the catch-up limit. Currently, it's at $6,500. 2022 limits have not been released yet, but currently it's $6,500. But you'll want to make sure that you are treating those catch-ups the same as you are for regular deferrals and including those in your match calculations. Same thing with Roth contributions. You may have pre-tax salary deferrals in your plan as well as Roth contributions. Both are considered deferrals, the difference being that Roth contributions are taxed at the time of withholding, whereas a pre-tax contribution has no tax withholding at the time of the withdrawal. So make sure that both of those are being treated as a deferral regardless of their tax status, and they're both being matched. Next, not distributing the summary plan description. The summary plan description is a booklet in more layman's terms of what the plan provisions are. So as a legal plan document, you would have the adoption agreement that we talked about earlier that houses all of the plan provisions. The summary plan description, like I said, is more of a layman's term booklet that describes those provisions to the participants. So make sure that you're distributing that to the participants. And for anybody who's first becoming eligible for the plan, make sure that that's included in their enrollment packet. And that way, one, you can say that you distributed it to all participants, but secondly, that they know the rules of the plan. Next, not allowing new employees to participate pursuant to the plan. So make sure you know what the enrollment, or rather the eligibility requirements are for your plan so that you know when new employees become eligible. And you'll want to provide the enrollment materials to them typically within 30 days, or no less than 30 days is what I meant to say, no less than 30 days, so that they can make a informed decision of whether or not they want to start deferrals in the plan. Next here is not capping the matching contributions based on the annual compensation cap. And we're going to go through an example of the new employee eligibility and the matching contribution calculation. So in this example, the ABC company plan has no age or service requirement, but they didn't offer Steve's enrollment into their plan for at least 6 months. So Steve has missed out on 6 months of deferrals. Again, there are fixes for everything that you may have made an error on, and in this case, there was an error in when Steve was allowed to enter the plan. So ABC company would have to make Steve whole by making an employer contribution for missed deferrals and employer match. The missed deferrals would not be 100% of what he would have deferred, but it would be 50% of what the average deferral rate was in the plan. So for instance, if your average deferral rate was 3%, Steve would be due a 1.5% deferral, plus any match that he would have received on that full 3%. So it could be costly if you are not enrolling people when they should be enrolled. So again, it's important to know when your eligibility dates are. But if you do get into this circumstance, just let your account manager know, and we can help you with determining what is due to that participant. So the next example is not properly capping the matching contribution. So in this instance, we have a plan's matching formula for 2021 is 50% of the first 6% of pay. The maximum that the employee can receive is $8,700. And this is based on the compensation limit for 2021 of $290,000. And that compensation limit is determined by the IRS regulations and is determined each year. And so again, the 2022 figures have not been released yet, but for 2021, the limit was $290,000. So in this instance, $290,000 compensation times the 50% match times the 6% of pay that it applies to is $8,700. So any participant in your plan with this matching formula would not be eligible for a match of more than $8,700. And now we'll go through an eligibility example. For eligibility, there is a maximum waiting period of 1 year. So you can't have a waiting period of more than 1 year. And age 21 with a minimum entry date of twice a year. And typically that would be January 1st and July 1st if you have a calendar year plan. In addition, a certain number of hours can be required in order to accrue that year of service, but it can't be more than 1,000 hours. So typically you'll see that a plan requires 1 year of service, and that means a year of 12 months that an employee has worked at least 1,000 hours. You can have a shorter or a lesser age requirement, but it cannot exceed 21. And of course, you can have shorter waiting periods. So the longest you can have is a year, but you can have a waiting period as much as immediately upon hire that they can make their own deferrals. So depending on the demographics of your company would make it reasonable or not reasonable to have immediate deferral entry or up to a year. The initial computation period for a plan of 1 year of service is the 12-month anniversary from the date of hire, but then it would typically change to the plan year. And this can get a little confusing because of the switch from anniversary to the plan year, but we're going to go through an example on this eligibility. So in this example, we have a plan that has a year of service as the eligibility with semi-annual entry dates. So if we have an employee that was hired 6/1/2019, we would look at his service for the first year of anniversary date, which would be 6/1/19 through 6/1/20. And since this plan has a year of service as the requirement, we would want to see if this participant worked 1,000 hours within this 12-month period. If they did, we have semi-annual entry dates, so that employee would become and enter the plan on the next semi-annual date, and in this circumstance would be 7/1/2020. So again, they had 1,000 hours between 6/1/19 through 6/1/20. They would enter 7/1/20. But let's say this employee did not work 1,000 hours from 6/1/19 through 6/1/20. Then we're going to have to change to the plan year, which is going to be 1/1/2020 through 12/31/2020. So again, we're going to switch from anniversary date to the plan year. And we're going to see if any subsequent computation period, which is the calendar year, has at least 1,000 hours. And if this participant did work 1,000 hours between 1/1/20 through 12/31/20, they would enter on the first day of the next year because we have semi-annual entry dates, and that would be 1/1/2021. So it's important to know, like I said, about the initial computation period being the anniversary date, and then switching to the calendar year or plan year date if that participant did not meet the eligibility requirement. And as I keep saying, your account manager is here to answer any questions that you may have. So if you have questions on how to determine someone's eligibility, just call them for help. In particular, as we're going to talk about rehires. Rehires can be a little complex because each rehire is handled differently. But to keep in mind is if a formerly eligible employee ever had a single vested dollar in the plan, they never lose their prior service credit. So they would become eligible upon rehire. So again, this is a participant who was eligible before they were terminated. They've been rehired, and they did have a single vested dollar in the plan previously. They would be eligible upon rehire. They would not have to meet the eligibility requirements again for this circumstance. Otherwise, they would lose their prior service credit after 5 consecutive one-year breaks in service. So if that employee was gone for at least 5 years, they could lose their prior service credit and have to meet eligibility again. But important here is just to allow rehires who have not lost their prior credits to participate in the plan immediately on date of rehire. If you are not letting them in, then it's considered a missed deferral opportunity, as we talked about earlier when we talked about Steve not being enrolled timely. It would be the same type of situation. So just contact your account manager if you're going to have a rehire come into the plan or come into the employment, so that we can determine whether or not they come in upon rehire or need to meet the eligibility requirements again. We have a lot of moving pieces in the plan, as you can probably already tell from what we've gone over already. And this, again, is why you have so many people involved in your plan that specialize in their component. The record keeper and the investment provider, they have the portfolio, the education, the requirements of the investment transactions, anything that has to do with the investments and the funds for the participants to be invested is going to be your record keeper. The TPA or NOVA is going to be with the compliance testing and the consulting, helping you come up with an optimal plan design and drafting of your plan document to meet the intention that you want. Distribution and loan expertise. When can a person get money out of the plan? And we're going to go over some of those examples. Government reporting and disclosure. So this would be the Form 5500, and we can help with any fee disclosures that we can pull from the record keeper as well. And then, of course, you have your investment advisor. They would have the client relationship in which they would be consulting with your employees and completing those enrollment meetings and helping with the participants to select the correct funds, or I guess not really correct funds, but the funds that that participant would like to be invested in, if that they can make that educational choice with that employee. And they would also have an annual review with you to go over the plan and how it performed the past year, if your fees were on point, if you have the correct funds, how those funds performed. All of that information is completed in that annual review. So looking at those moving pieces, there's several things that need to be done throughout the year. And of course, the first one and most important is how the money gets to the record keeper. The record keepers typically have a secure website in which you would upload the contribution information. And as we talked about earlier, there could be a involvement of the payroll company with that payroll integration that could help with that with you. But in any case, that information for those contributions needs to get to the record keeper. When that information is uploaded, the contribution is separated into different buckets of money. So you may be uploading the pre-tax deferral, Roth deferral, and maybe you have a safe harbor match. Those contributions are uploaded separately, and then they're tracked separately into a separate bucket of money at the record keeper. Who calculates the employer matching contribution? This depends on how you want to calculate your matching contribution. If you're wanting to calculate your match on a payroll by payroll basis, the match would typically be calculated by your payroll company or by you as the plan sponsor. If it's calculated annually, then NOVA is usually calculating that for you. And that's after we get the census information each year. We'll take that information and calculate that match for you and provide you with a spreadsheet of the allocation with name, social, and the dollar amount. And then you can use that spreadsheet to upload to your record keeper. Who's responsible for preparing the Form 5500? Unless it's a special engagement, NOVA is going to prepare your 5500 for you. You'll be responsible for reviewing the 5500 and electronically signing it and submitting it. But we can, of course, help you with that and help you review the 5500. If you have questions on where the figures came from, just contact your account manager. And then also, if it's the first time you've electronically signed the 5500, we can help you with how to obtain those Department of Labor signing credentials. The signing credentials at the Department of Labor would be a user ID and PIN number that would act as your electronic signature. And so once you have those two pieces of information from the Department of Labor, you can use the link that NOVA will provide and sign your 5500 electronically. How does an employee get distribution paperwork upon termination of employment? We suggest that you give any distribution paperwork at the time of an exit interview for the participant. When you're giving them their COBRA notices or any other medical welfare plan data to them, give them that distribution paperwork and also a notification that if they are not going to take a distribution within 30 days, then they would be rolled to an IRA. This way, the participants, in a case of an audit, you can say that you gave that terminating employee their distribution paperwork and you made them aware of the force out rules if they have less than $5,000, that they would be forced to an IRA. And that would start your clock on that 30-day notification. Upon request, we can mail this information to employees. But like I said, let us know about if you need our help with this, and we can get involved and let you know the best way to do that. Who's responsible for distributing required notices? Typically, that's going to be you as the plan sponsor. We do have a sister company, AFS, which can help with the distribution of these notices each year. But depending on the provisions of your plan, you could have several notices that are required. We talked about the summary plan description. The easiest way to get that to participants is when they're eligible for the plan, give that to them with their enrollment packet. Afterwards, it only needs to be given to participants if there's any changes in the plan. So if there's changes in the plan, there would need to be a kind of mass communication to everyone that there's a new summary plan description and be distributed. The next notice is the summary annual report. This is the summary that's provided to participants that outlines the data that was on the Form 5500. So at the time of the 5500 signing, you'll also receive that summary annual report, and that will need to be distributed to participants. Next would be a special tax notice. The special tax notice is letting a participant know the taxes that are applied if they take a distribution from the plan. So that's required to be given to participants when they take a distribution from the plan. If you have a safe harbor formula that we talked about earlier, if you have that safe harbor provision, it requires an annual notice each year, which is due no later than December 1st of the year prior that it applies to. So for 2022, that safe harbor notice would need to be distributed to participants by December 1st of 2021. Next would be the annual 404A5 fee disclosures. This would be letting the participant know what fees are involved in the plan, whether it be fees from the funds, fees if they take a distribution, anything that could be pertaining to a participant, this disclosure would outline to them. Next would be the annual automatic enrollment notice. We didn't talk about this in this presentation, but automatic enrollment is available for any plan that wants to add this feature. And what it does is it automatically enrolls participants at a certain level, just a 3% of pay, if a participant does not fill out an enrollment election. And this is good for companies that have participants that you think that would like to participate, but because of just general inertia of people not wanting to complete the retirement plan paperwork, they might not enroll. And so this is a good way of getting them enrolled in the plan and saving for their retirement without them having to do much to do that. So again, it's just a good way to get participants in that you think would want to use the plan, but your demographics of employees, they just like I said, general inertia won't fill out the paperwork. So again, talk to your account manager if you want to think about adding automatic enrollment to your plan and how that would affect your plan. So as you can see, there's a bunch of notices that were required to be given each year. And again, we can help you with that. Our sister company can actually deliver those notices for you, but your account manager can also help with finding where these notices are and when they're required. Next, we're going to get into a participant's favorite part is usually how do they get money out of the plan? If they leave employment, that's probably going to be the first thing that they want to know. And again, we just recommend that you give the termination paperwork to a participant during their exit interview. But besides terminating employment, there are other reasons that a participant can take money out of the plan. Those reasons are pretty specific, and it's specific because the plan is intended for retirement. So we want to make sure that there's not people using this as a savings account or checking account, just taking money in and out all of the time. But there are different options in case a participant needs the money. The first we'll talk about is age 59.5 withdrawals, hardship withdrawals, and then unfortunately if a participant dies or becomes disabled. If a participant terminates employment or retires, then they can withdraw their funds upon termination. They can submit the paperwork prior to the termination date, but it can't be processed until after the date of the last day worked. Also, most record keepers won't distribute the funds until after the final payroll contribution is received. So this is the reason on distribution paperwork that you'll see that they're asking for when the last contribution will be deposited. They're just making sure that they have distributed all the funds to a participant rather than one more contribution coming in and having to receive a second distribution. And as we talked about a few moments ago, you'll need to provide a tax notice with that distribution form. And typically that's included in the termination form itself. So typically it's not a separate notice, but some vendors may have a separate notice in addition to that paperwork. Age 59.5 is typically called in-service withdrawal, and it's because a participant can withdraw money after age 59.5 if they're still employed. This is an option in the plan, but you're not required to have this in the plan. Typically, employers will want to have some reasons that a participant can take funds out of the plan. And this one is popular because it starts getting people ready for when they're retiring. So when people turn 59.5, that's typically when the early withdrawal penalty of 10% goes away from the IRS. And so after 59.5, a participant would like to start taking withdrawals and maybe moving it to their own IRA and dealing with their own financial advisor for getting ready for retirement. That's typically the reason, but that doesn't have to be the reason that a participant takes money out after 59.5. If you offer this in your plan, it can be any reason that they want to take the funds out of the plan. And this does not inhibit their availability to keep contributing to the plan. So they could take a full distribution and still keep making deferrals into the plan or getting employer contributions as well. The next option is hardship distributions. This is for participants of any age And this is not required. Again, this is an option for the plan, but this would allow participants to access their 401k account in the case of an emergency. And there's very specific reasons as to why they can take the money, and we'll show you a listing. And typically it's subject to a 10% early withdrawal tax because it's being taken out prior to age 59 and a half. So here's a listing of those hardship distribution allowable reasons. And again, you can see it's very specific, and it's very specific and requires documentation. So this kind of takes you out of the equation for having to determine who has a hardship. It's determined by the regulations and has to have supporting documentation. There were some new rules as of 1/1/19. You used to have to take a plan loan first in order to take a distribution for hardship. That's no longer the case. You used to have to stop withholding deferrals for these participants. That's no longer the case. They can keep contributing their deferrals even if they take a hardship. Investment earnings on employee deferrals are now available for withdrawal. Previously, they were not available for withdrawal. Employer contributions may now be available for hardship withdrawals. And this can be set in your plan document as well. So if you want employees to only take from their money and not employer money, you can make that provision to the plan. And then safe harbor contributions are now allowed for hardship withdrawal. Previously, that was not allowed as well. Unfortunately, if you have a death of a participant, I shouldn't say unfortunately, they can take their funds, but if you have an unfortunate event where one of your employees has passed away, those funds are distributed to the beneficiary election. If there's not a beneficiary election on file, the money first would go to the spouse. And if there's no spouse, then it would be the children, then to the parent, and then to the estate. So there's a determinable listing of how that money is distributed if there's not a beneficiary election on file. But of course, it's important to have the beneficiary election on file so that the money goes to who the participant intended. If a married participant does not want the funds to go to their spouse, then they must name another beneficiary on their form, and they must have spousal consent as well. Age 72 distributions. You may have heard age 70 and a half distributions. Recently, the regulations have changed. This age is now 72 for anyone who is beginning minimum required distributions. And what this means is that a participant who turns 72 must start taking money out of the plan if they are terminated, or if they are an owner of the company or an owner family member. So in addition to those people who have terminated employment, those owners and family members must start taking age 72 distributions as well. And NOPA will let you know typically September or October if you have anyone that meets those definitions. We'll send you signature ready forms for them to be able to take these age 72 distributions. Quadros, you might have a qualified domestic relations order come up. This is usually when a participant is getting a divorce, and it allows for a portion of the account balances to be distributed to their ex-spouse. The rules are complicated, as we say here, so please get help. If you get a domestic relations order in, please send it over to your account manager, and our distribution team will review the domestic relation order to make sure that it's qualified. It has all of the information necessary in order for it to be acted upon. Spousal consent. There are very few plans that spousal consent is required. Typically, it's only required if you have an old money purchase pension plan and that participants have a certain dollar amount. So if you have just a regular retirement plan with no old money purchase pension plan money, Typically, your spousal consent is not required, but of course, if it is required, it's extremely important to get their consent, unless the distribution is less than $5,000. Loans, you can offer loans in your plan. It's not required. Again, it's not required in the plan, but can be offered. And typically a plan sponsor would want to allow this to make it easy for participants to be able to take money without having a distributable event. So as we talked about, the hardship withdrawal could carry a 10% early withdrawal penalty. In addition, they would be taxed on the funds that they're withdrawing from the plan. When you take a loan, the loans are repaid through payroll deduction, so it wouldn't create a taxable event, and a participant could take some funds out and repay themselves. So it is popular to offer these to the plan, but we do advise to only allow one loan at a time. It can just become an administrative nightmare if you have more than one loan for a participant. So if you offer one loan, it's usually not too administratively impossible to deal with. And again, that does come through their payroll. You don't have to worry about tracking down an employee and their payment. And those loan repayments, once they come out of payroll, would be deposited the same manner that you're depositing their deferrals. There are rules to how much you can take from the plan. It's going to be the lesser of 50% of the vested account balance, or $50,000 reduced by the highest outstanding balance of a loan within the last 12 months. Most plans provide a minimum loan of $1,000. You don't want to make this seen as, like I said, a checking or savings account. So you don't want to have participants taking money in and out at all times. So if you make the minimum loan amount of $1,000, this means a participant would need to have at least $2,000 in the plan in order to take a loan. Loans must be at a reasonable interest rate. Typically, that's 2% over prime rate. That interest would be paid back to the participant's account, so they're paying their self-interest, really. The loan must be repaid within 5 years unless it's for a residential mortgage loan. And if it is being taken for a residential mortgage loan of more than 5 years, there would be documentation required. However, that would be the only instance in which you would have to obtain documentation for a loan. Loans are paid through payroll deduction on a post-tax basis. So this isn't like your normal pre-tax deferrals. This is a loan repayment that is a deduction, but it's on a post-tax basis. And then loans are generally becoming due upon termination of employment. Since those loan repayments are being made through payroll, that means there's going to be no payroll left for them to take that loan payment from. So those loans will become payable upon termination of employment. Fees for a loan, there are usually a loan initiation fee, as well as the record keeper may have an annual or monthly maintenance fees, and the participant does bear the cost for loans. If a participant wants to know the fastest way to get a loan because they need that money, apply online if the record keeper offers that, and request an ACH instead of a paper check. So that is the presentation as far as introduction to 401k and the loans and distribution basics, the testing. We've gone over a lot of information. And again, I don't know that we're going to have time for questions during the presentation, but we will email you back with the answers to those questions if we don't have time. But I do want to go through the annual calendar here and just let you know what to expect throughout the year from your retirement plan. And we've broken this down by month. Some of these items you'll see as a duplicate on each month, and it's really because it depends on what the eligibility is for your plan. But then some of these are administrative tasks that I kind of want to cover here. The first you'll see at the top left here in January is 1099s are distributed by the record keeper no later than January 31st. So if you had an employee who took a distribution from the plan or maybe required a refund, as we talked about way back in the average deferral percentage testing, the record keeper would provide a 1099 to that employee by January 31st that would be applicable to the prior year's taxes. Also, January is typically when you're going to submit your year-end census information to NOVA. We'll be sending an email to the contact that we have on file, and then you can upload that census data to us, as well as the questionnaire that we had talked about, asking for the owners, the family members, all of that data. And you can submit that online, and we'll get that information and start working on your testing. Also, the participants will be receiving their fourth quarter annual statement from the record keeper. So their fourth quarter 2020 statement would have been in January 2021. And again, some of these are going to talk about the entry dates. So again, make sure that you know the entry dates on your plan with the eligibility, and you can flow through to those months depending on what your eligibility is. If you didn't submit your data in January, you're going to want to submit it in February. The due date for the failed deferral testing is that a refund must be completed from the record keeper no later than March 15th. So if we're getting your census information the second week of March, there's just typically not any way possible for us to complete all of the compliance testing and get those refunds processed by March 15th. So if at all possible, have your data submitted in January or February, and I would even say early February, so that we can get that completed for you. But so in saying that, January, February, March, we're going to be working on that compliance data to be able to meet those deadlines for you. April is the deadline for the first age 72 distributions. So if you have a participant that's turned 72 during 2021 and they've terminated employment, the deadline for them to receive that required minimum distribution is going to be April 15th of 2022. April is also going to be the deadline for any excess 402G limits. This typically comes up when a participant has moved from one employer to your employment. They may have deferred over with their old employer, and then once they got to tax time, realized that they've gone over the annual deferral limits that we've listed here for 2020. If they've gone over the annual limit, the excess must be returned by April 15th. Let's see. In May, NOVA is going to begin working on your Form 5500 for any information that we've completed for compliance testing. And we're going to be working on those 5500s to the due date of July 31st. Typically, we want to provide you with a draft 5500 at least 30 days prior to when it's due, so that you have time to start reviewing that 5500, get your Department of Labor credentials if you don't already have them, and make the electronic filing by the due date. If you have a large plan, typically we want those audits to start in May so that the auditor has time to get that audit done and the 5500 filed by July 31st. Let's see. Again, here's the due date for your 5500. If the information has not been received or the audit will not be done by July 31st, you can file an extension. That extension would bring you out to October 15th. We'll have over here in the October month portion. And October 15th is the last date for the 5500 to be filed. So there are no other extensions. And the 5500 late fees can be substantial and can be assessed by the Department of Labor and the IRS. So it's really important to get that data to us as early in the year as possible so that everything can be can be completed by that extended due date of October 15th. We just go back here and see if we have something that I want to cover here. Oh, the summary annual report. We talked about the summary of the 5,500 that needs to be distributed to the participants. If you have a due date of the 5,500 of July 31st and have not gone on extension, that annual report is required to be distributed to participants by September 30th. So we want to make sure that that's distributed as well. NOVA is going to begin annual mandatory cash out project. So I kind of briefly touched on if participants have less than $5,000 and have not returned their distribution paperwork within 30 to 45 days, those small account balances can be forced to an IRA, and NOVA will help you with that. So in September, we're going to start going through the plans and seeing if you have anyone that falls into that category, and then distribute notices to the participants and give them that 30 to 45 day window to return that paperwork. Again, this is fully extended due date of the 5,500. That's a really important one, so keep in mind that due date. Each year, we'll help you again with the 72 age RMDs. So in October, we're going to start looking at all the plans to see if you have anyone that falls in that category, and then provide you with signature-ready forms for those to get processed by December 31st. December 1st is a big date for notices. We talked about the safe harbor notice and the auto enrollment notices. In addition, you may have a default investment notice, and this would be any default investments that you have that participant would be defaulted into if they didn't make their own election. So make sure those notices are sent out by December 1st. Summary annual report. If you had an extension for your 5,500, your summary annual report is going to be due to be distributed in December. I think that handles the annual calendar, or at least what I wanted to cover on that, but let us know if you have any questions with anything that you read on there. In addition, I had mentioned our sister company, AFS. If you have a lot of notices that need to be distributed and you want that to be taken off your plate, just contact Jake at AFS. Here's his email address. He can help you with what that pricing would be and help you, talk through that as far as your distribution of your mailings. Otherwise, we have our upcoming schedule on our website. You can visit there for any upcoming webinars. And then just to complete the evaluation survey at the end of the presentation, which Jasmine will go over as well. And then otherwise, I want to leave this up here on the screen for a second for you to be able to email me or call me with questions. But of course, you can contact your account manager as well. Jasmine, I'm not sure if we have any questions, but it looks like we only have a few minutes left. So maybe we'll save those and email any responses.
Yeah, thanks, Charlene. We actually haven't received any questions, but if anybody does have a question, please feel free to reach out to your account manager, or you can email webinars@nova401k.com. And we just want to thank everyone for joining us today for an introduction to 401k plans. Please note there will be a survey that will pop up right after the webinar ends. So if you need Texas CPA or ASPA credit, please complete that survey. The certificates will be sent out by the end of next week, and the recording of this webinar will be made available on our NOVA YouTube channel by the end of next week as well. If you have any questions, again, please reach out to your account manager and they'll be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. Everyone have a terrific Thursday.
Thanks, Jasmine.